everybody. Welcome to our next episode of Future Focused CXOs. I have a very exciting guest today. I have Bill Fahrbach with me. He is the CFO of Facet. And without any further delay, let me welcome Bill to our podcast. Bill, welcome to the podcast. Can you please introduce yourself and give a brief overview about your background?
Sure, and thank you for having me. I'm Bill Fahrbach. I'm the CFO of Facet. Facet is a B2C fintech company that does subscription-based financial planning, targeting the mass affluent market. So if you think of your typical old school financial advisor, everything you think of when you conjure that image, being out on the golf course, entertaining clients, and those clients having a lot of money, the Facet model is very different. In fact, it was built off of the idea that people who didn't have the money to attract advisors in that model, because those advisors need assets in that model. It's an asset under management fee-based model. To attract somebody to work with you, you had to have those assets. And for us, we've built a platform and a process with our planners and our tech that allows clients in that mass affluent segment, so 100 million in assets, to engage with us and get great financial planning. And I think the second piece to that is that we tend to believe that the legacy financial planning models as well aren't that good because they really strictly focus on investments. They don't cover the day-to-day life experiences that people face. You're going through tons of changes in your life, and they all affect your financial life. And being able to adapt to that and change is really critically important. So we've covered that in a way that's effective and also cost-effective. So I got here to the business just about 3 years ago off of my prior sale. And I've been CFO of technology, mostly subscription SaaS businesses for the past about 13 years now, all private equity backed. Early in my career, I was in investment banking. I was advising capital raises, doing M&A advisory for really fast growing technology businesses. As I was doing that, I was meeting with management teams. And every time I met them, I was like excited by what they were doing. I was like, these guys are tackling big problems. They're moving the business forward. They're in there. They're doing it. How damn exciting is this? This sounds great to me. So I decided to go off to business school to move into this world, to be an executive in great, fast-growing tech businesses. Actually, at the time I did that, this was about 2007. It was a bit of an unusual idea. Friends and colleagues were like, you idiot, you've got a good career path here. It's stable, your path to make good money. Why would you work with companies that I have never heard of? And so I went up to business school really to make that transition. And what was interesting over that time frame was leading into the financial crisis in 2009 is that the typical class at that point would have been heavily weighted towards going into consulting or investment banking. And a lot of them were coming in, but when the market really shifted, this actual idea of people with great skill sets and understanding of the markets going into middle market or lower market, fast growing businesses and growing them to $1 billion in revenue, $1 billion plus, instead of entering the businesses that are already at scale was a new idea, but my entire business class was gravitating towards that. So it ticked me off. I felt like I was like novel and getting in there before anybody else. And I go there as the renegade and I came out just like everybody else, looking to move into this world. So that's how I got here. That's how my path has been. And it was pretty logical for me to work with private equity firms simply because I had worked in that world before. And I understand how investors think and how bankers think. So it's a very natural, easy conversation with boards and with investors. And obviously that properly and naturally leads to building good businesses that carry the right attributes to then be able to do additional M&A or sale processes, what have you. So I've actually sold 4 businesses in about 13 years. So it's been very busy, very fast, and very rewarding. So that's me in a nutshell.
Wow.
Given your considerable experience in private equity, talk to us about why your approach seems to be so successful. You know, I've been with 4 exits in 13 years. That's a pretty aggressive approach. So what is it that seems to be different than what typical business owners or typical C-suite leaders tend to be thinking about that is missing this opportunity to move at the rate that you've been able to get companies to move?
That's a great question. Some of it, quite frankly, is chance. Because when you're working with private equity, there are a few different timelines at play. You have the business itself in terms of where it is and what your opportunities are and how you're capitalized to continue to grow the way you want to grow. But you also have the private equity clock and timeline. And so that can sometimes mean private equity just needs an exit. You're going to bring in another private equity firm and you do another round. It sometimes means that a strategic buyer is going to step up and come in the equation and wants to own your business and tuck it in. In my case, it's biased towards having some strategic investors step up with an interest to own. And there's always been private equity interest in every single deal. It's been mostly private equity interest in every deal to do the next level of growth. But when the big companies come in and they have real strategic reasons to own you, they will go out of their way to make that acquisition. So I think some of that is simply chance on one hand. I think on the other hand, this is a pretty tough environment to operate in. When I say this quote unquote environment of high growth, a degree of ambiguity, improving the business systemically, making really important strategic decisions, and then making sure you have really good rails on the business to grow to several billions. That requires many different types of minds all at once to get there, right? You have to be a bit of an architect, a bit of a visionary. You have to understand what investors are going to want to see. You have to work with people who will come from all different backgrounds. You have some people who might be from the earlier stages, and then you may have others who are coming from gigantic businesses and coming in, and people think differently and have totally different experiences. So all the challenges you're tackling, you need to not only have a good pulse on how to tackle them as CFO in particular and as CEO as well, but you also have to know how to bring people along. And that's probably the hardest part to learn in the very beginning. You can get the formula down. I'd say by 2 exits in, not that I learned everything, I learned every single time I have a new exit, but you do start to learn certain elements of the formula by going through those exits. And the one thing that's the hardest to learn is how to bring people along who haven't been through that experience and get them incentivized or understanding of why they're doing the things they do. Because you have to do things that aren't necessarily natural to somebody who's either just been in a startup or just been in that giant company. So it's a really interesting market. Like I always say, if I were on the private equity side, it would be daunting to hire executives in these businesses because it's a challenge, and getting the right people together is a challenge. So I think I've just been fortunate to have the right mix of background and then gotten into the right deals and worked with great people. And so all those things have come together very nicely for me.
Do you find that the private equity company comes to you for specific expertise, or do you tend to go bring the private equity group to you, or a little bit of both?
Yeah, everything happens really. Private equity firms will come to you and say, hey, we want to bring you into this specific business, or they'll say, sometimes generically, we want to bring you into the portfolio. Let's keep our eyes open. Or you might see a business and say, that's interesting, and I know that some moves are being made there. Let's talk. It could be all of those things. They're always doing deals, obviously, a little bit less in this environment than in the past. But generally speaking, they're always doing deals. So they're always on top of understanding what their needs are. And so there's always an opportunity for discussion. So for me, as somebody who's gone through exits and sold to strategic, those are conversations that I tend to keep pretty active in, right? Just to make sure, because you never want to be in a position where you're just out there and starting from scratch. So having those relationships helps that, because the private equity firm you work with is important. Particularly the partners or the team that you're working with is really important. But the business is probably, I'd say, in many cases, the most important thing. So you need to understand and prove out that you're going to have a great underlying business with great backers, and you're going to have a team around you and a commitment to a team around you that will succeed in the process.
Okay. So I think what we heard last time from you were that you immerse yourself in technical and in technology, right? Being a CFO, little unusual, right? CFOs getting deeper into technology. So I have a couple of questions onto that. So first and foremost is, what experiences led you to really start yourself getting deeper into technical aspects and understanding the technology parts of the business?
Yeah, I think when you say technology, I think there are two sides to that. There's the technology that you are bringing to the market. As an executive, understanding that inside out is obviously critical. And it's a differentiator, and it's the value very often that you're bringing to the market to get valued on. Internally, which I think it sounds like, is your question more internal in managing
both
business?
Yeah, both parts, right? Yeah, because even for externally what they bring to market, I don't think many of the CFOs go deeper into technical parts of it. They remain at a level of features, functions, pricing, and ROI that it's generating to their customers, right? But you are getting deeper, one level deeper. So both sides I really wanted to understand.
Yeah, I think every CFO wants to understand that. And it's possible that some, I can't say what everybody does. I can only say from anecdotally. I think that some feel like they frankly can't prioritize it because there's a lot of other things going on, and getting into the weeds on that is a bit of a challenge. I think in other cases, there's a bit of a knowledge gap in terms of understanding what's going on there. I have just enough knowledge to be dangerous there, like from studies back in the day. I was in electrical engineering. I was a math major and all those things. So I've done coding and all that stuff. So I have a bit of a twist where I can talk one-to-one on something. By no means proficient in those things, but enough to understand what's going on there. So that helps me. But I would still say that's probably one of the harder areas, right? If you say like, how are you investing in any given area in your business? You can establish formulas around a lot of things like sales and marketing, right? You could say, here's what we need to do. Here's what success looks like on a per rep basis. Here's how marketing spend needs to perform. Technology is very different, and the timelines and expectations, particularly within your own team and within the board, are very different, where it's like you have to map out results on multiple time dimensions with tech. What I find with tech, if you're building tech to go to the market with, the biggest challenge is always getting stakeholders to align around what you can build quickly and what takes a long time to build, and how patient you're going to be and what the proof points are along the way. So you might be building something that's going to make the business 20 times better in 3 years, but you have to know that you're actually marching towards what you said you're going to make in 3 years, and B, that the people who are interested in that path are patient enough and understanding enough as you're going along that way. In a world where resources matter and capital matters and the markets go up and down, you have to align people around the commitment to it. And I've always found as CFO, that's one of the most important things to do, is get people aligned around the tech spend, and don't go in a direction of building a long-term path, a long-term roadmap, until you have that full alignment and agreement on what those outcomes should be. So that's on the go-to-market side.
Outside.
Yeah, I think internally, what's funny is like, what even is a CFO at the end of the day, other than that they manage the financial side of the business? Everybody has a totally different take. Like I could pick 100 CFOs out, and they're all very different, and they all have like different companies that they would fit really well in, and everybody has their different own positive attributes. For me, being CFO in the types of technology businesses, private equity backed, leading towards getting really good outcomes, like very much analytic focused, metric focused, I've always found that if you come into a business as CFO, you never ever have the data you need to be the best CFO you can be, right? And for me, internally with tech, there's always a bit of a discovery process where you say, all right, one of the first things you do is you learn the business and the people upside down, inside out. And then you say, all right, maybe starting with the finance team. How do I take the finance team and really accomplish two fundamental goals, which is put the rails on the business, create the stability, the management around cash, all of those things that we're going to need to succeed over the long haul, and even be efficient in the short haul, obviously. But then second, to have the right level of insights. And if you accomplish building like a rock star accounting team and a rock star FP&A team, that's only half the goal. Like they'll only be as good as the inputs from the organization. Or I find myself then as CFO, if I don't have inputs from the organization beyond that, I can't do my job as well as I want to, and I can't help the business as much as I want to. So I've always, whether I directly manage it or I am very much a stakeholder and ingrained with it, I've always taken a deep position in making sure that our internal structures get us the information that we need, but also allow us to function efficiently. And those two things can be done synergistically, which is one of the really nice things. You structure your internal tech the right way, it not only saves the business money, but it makes you much more sophisticated in terms of the information you have. It's taking a look at where you are, simplifying your structure, but at the same time adding sophistication in ways that stakeholders can use it to be better at their jobs, but it also then gets you real-time data for FP&A to be a leader in terms of reporting and analytics.
Okay. So one last follow-up on this is wearing your private equity hat, right? And doing this evaluation for you, how much do you value and what weightage do you put in terms of their external or go-to-market technologies that they have? They might have a fantastic product, for example, right? But it might not be on the technologies which the world is moving forward So there's a lot of refactoring and rebuilding and a lot of things might have to happen, right? So how much weightage do you give to that factor when you're looking at from a acquisition perspective or selling perspective of the company from a private equity hat? Similarly to the internal system, saying that everything looks perfect, but internal systems are, for example, really broken and people are doing a lot of manual processes and QLC operations, right? How does those factors come in from a private equity perspective?
You mean in terms of what private equity cares about, or in terms of how it would affect, let's say, value?
Acquisition perspective, how much do they care? What factors do they care about?
Yeah. Okay. So what I would say is this. I think that at the end of the day, the timing matters. So let's say private equity is valuing a new business. They do like to see an opportunity to create value, right? In the sense that if they see things that are broken, that they can come in and fix them from the start. To be honest with you, as CFO, like that too. It's rare that I've inherited something and said like, all right, this is like game ready, right? Usually there's a degree of knock some things down and build it back up. I view it the same way. However, the business is going to pay for that, right? So if private equity comes in and says, look, here's a great business, but the guts of it are a mess and we can't get information, it's going to affect your valuation for two reasons. One, they're going to have to build it to be able to scale it. So that there's time and money involved with that. But the second, maybe more important, is that going back to the data, what can you believe is the reality in the business if you can't be sure really what the data is telling you and you can't get data to tell you certain things? So it's pretty common. I would say it's more often the case than not that the system and data and technology infrastructure of businesses is subpar. And so I think they're used to working with that. I think the distinction is when you actually have something that's rolling and is in really good place, that it would positively affect the valuation of the business, because the investors then come in. If you have that, management comes across really well because management knows its stuff, because it's been operating with good information, making strategic decisions with good information at their fingertips. And that comes across. So that's on the front end. The second piece is on the back end in diligence. When they dig in, they say, oh, these guys are really well designed. Like they have everything they need. They're operating relatively efficiently. They have relatively a great wealth of information that as we're looking at it, we can believe in. All of those things are going to lead to a better valuation and a better close. And it varies by deal in business, like how much of an impact that would have. But those are really important. So on the other side of the coin, if I am buying a business, same exact thing prevails, right? So if I'm going out to make an acquisition and I look at it and I say, all right, this business in the past did 4 acquisitions and there are like 4 distinct ERPs floating around different countries. And I'm going to look at that and say like, all right, I'm going to spend a lot of time with my team getting this together. It's going to take me a lot of time on the front end, just doing diligence to understand if the numbers are right. So I got to get through those things and say, all right, how much am I going to fix, which I might be okay with. I might have the capacity to do those things, but I'm not going to pay a premium for that business, most likely, right? Unless there's just something incredibly strategic or there's unbelievable synergies that you're going to overlook that for, or the market's just something that's insane at that point in time. All else equal, you're not going to pay up for a business that has those deficiencies. So just putting the deal element in the picture, it's worth it just there. But I think the broader point and the bigger point is that you can't operate your business fully effectively without it. If you don't have that infrastructure, you're both draining money and you have not good enough insights because you have not established that. The biggest challenge, and I think why people don't commit to it always, is that it's not necessarily easy to do. You look at so many businesses that fail at it. So I think there's a degree of skepticism. If you go to a private equity investor and say, hey, look, we're going to spend X millions of dollars cleaning up our infrastructure over the next 2 years, they're probably going to say, yeah, that makes sense. But from experience is probably a degree of skepticism as to how effective that's going to be, because they see failed implementations.
Many times, yeah.
So the challenge, I think, is one of these weird things where it's like, what's sort of like the weighted average value to doing it? I think if you do it right, the value is clear and it's there. You have to make people comfortable that you're going to do it right.
Okay.
With rising interest rates, it's changing the perspective of private equity, probably also of buyers, strategic buyers that you're looking at. What kind of challenge, or can you give us an example of a challenge or pressure that changed in your thinking based on the decisions you had to make in light of this new type of environment that you find yourself in?
Oh, sure. Yeah. God, if you go back till 2021, it's night and day, right? Money was so cheap and so growth oriented at that point. And by the way, that's not necessarily a good thing. It's like, we want to talk about like things were great. Things need to correct sometimes too. And you could probably pretty reasonably, I would at least, somebody could disagree with me, sure, but I would make the argument that it was a bit much back then, right? There just wasn't enough focus on things that are really important systemically for the business. And how does that come into play today? It comes into play massively. And the reason it does is that with the shift in interest rates and a general de-risking, because to the extent that those are rising, if I want to go out and raise capital, my cost of capital is going up, which means that effectively my hurdle for returns is also up on the things that I do and spend money on. So where that comes into play with technology is that by its very nature, technology is really, it's difficult to pinpoint returns on, right? Like I can look at an average salesperson and say, all right, they carry a quota of $2 million. And I know over time that if I bring in 10 more, like they're all going to achieve that, or they're going to achieve it 80%, whatever the numbers are, right? Like I feel pretty comfortable deploying those dollars. I know what I'm going to get. If I deploy another 50 million in R&D expenditures, there's a pretty wide variance as to what I'm going to get. And that means more upside and more downside, but it's a higher variance. So you take the risk of that variance and you layer that with a higher cost of capital where the market is becoming more risk averse. And it's harder to get people comfortable with the expected outcomes on technology spend for those reasons. And I should say as well, too, the timeline as well, right? So it's taking time to develop these things. They're not immediate paybacks. So the idea of when cost of capital is high, taking relatively expensive money to invest it in a long-term project that could carry a high degree of variance, that doesn't mean that you maybe by the math, it carries the right return. It might carry a great return on the page. It's getting people comfortable with that being the way that you're going to spend your money as opposed to doing it with other things.
All right. Yeah, that makes sense.
Yeah, I think now coming back to technology, we saw in pandemic, right, a lot of companies went overboard with automation technologies, not in a strategic way. Most of them went in a quick fix way, right? Band-aid way, saying that I want to quickly fix this. My employees are working outside. I have exposure to compliance. I have exposure to not knowing what they are doing. I have exposure to not understanding and helping them, right? Making them more productive, right? A lot of ways people jumped in and did that, right? And particularly if you look at these operational systems like CRMs and Salesforce and other things, right? We saw a huge jump in the requirements. Like we grew 3x during that time. And we did see some layoffs happening where people are trying to rebase of market requirements to the capacity they have. But in case of technology, you work with a lot of companies through private equity firms and other things. So the question really is, in case of technology adoption and rationalization and digitization and transformation, right? What do you see as a long-term strategic planning that these companies are doing?
I think I would sort of couple that with what we just discussed around the inherent risk with technology. So I think the short answer, frankly, on that is people acknowledge that those investments are important and carry merit. They're going to put a really fine prism over that though as well and say, what is my certainty of outcome? How do we speed these things up and get the right outcomes in a way that, to your point, aren't garbage outcomes, like rush with too little dollars to get something that doesn't exact work at the end of the day. I think that though, I would say another thing, and this might be my thing, this is how I think about it, is that when you have a situation like this where the market was so wildly bullish about growth and like any innovation expenditures and so forth, and now it's really swung in the other direction, right? It's like very much risk off and focus on profitability for sure. Maybe a subset of that answer is that might be the question by which a board member might ask is like, how is that going to help efficiency in a way that boosts our profitability, as opposed to how is that going to be something that groundbreakingly makes us accelerate in ways that are innovative or growth oriented? So it just might skew those a little bit. But I also do think that this is an opportunity for everybody to rethink what tech needs to look like and be forward looking on that as well. Look at technology every 10 years, right? Particularly if you go back every 20 years. And the way it's applied is so different, right? And I don't want to throw out the AI buzzword just to throw it out, But I think figuring out the little niches of things that are going to really work is also important here. Because if you're going to take risks in investing in things for the future, you have to invest in ways that are consistent with what the future is going to look like. I think this has been a really good time for businesses to take a step back and say, all right, this is what we've been doing, and it's been effective for various reasons. Let's think about ways to innovate on the tech, right? Like you think about what you thought of tech 50 years ago or 30 years ago or 20 years ago. Now it looks like nothing. It's like a piece of metal compared to what technology is today. So thinking forward to what are the things that actually I'm going to need to do with the business to keep up with what businesses are going to look like 5 to 10 years from now. I think forward-looking people are doing that today and will benefit from it 5 years from now. And there's an opportunity to do things in ways that you'll be way ahead of the pack if you could think and forecast the right things to do there. So this is like, as much as spend on innovation might be declining, I think with that, the approach towards innovation, anytime there's a gap where people have some time to think about things and reorient, I think that'll really set the trend a little bit different. It'll be to do mostly similar sorts of things, but in new ways, right? And get them done more efficiently and maybe more cheaply, so forth and so on.
Now that technology has become so infused into everything, right? Every department is investing in technology that makes it more efficient. It seems like the situation now after growth is that everybody's being more intentional.
Yeah.
It just seems like you have to be a lot more intentional about what you choose, how you choose it, how you involve and integrate it, and get the best use out of it, and thus giving you a better sense of where our profitability is going to get achieved through this infusion of this technology in this way. I noticed we talked to a lot of CXOs that have somewhat of a nonlinear career path. Some have even almost fallen backwards into the C-suite as opposed to, and I don't see yours as much that way. It's more like you were going down a specific path, you were comfortable in that path, and then you saw something that really lit your fire and you were intentional. You went back to school for it, you got involved in it, you stayed in it, and you've made a success of it. When you're thinking, oh, what kind of advice would you give future C-suite leaders around the idea of the value of both the discipline you engage and the intentionality towards going this specific path, even though your friends were probably telling you you're nuts?
Yeah, I guess you have to be nuts first. That's a precondition.
That's a good start. Okay.
So find a way to be nuts, I guess, is part one. I think some of it is mentality, right? I can tell you how I've always thought about things. And I think it is probably against the grain in a lot of cases, right? I've never really approached my path from a position of like, how am I going to do the next thing to necessarily climb some sort of ladder? I've always approached it from the path of where am I going to be really challenged and engaged? And so that's led me personally to not be scared of some things that maybe others might be like, that business needs to get some things done that are going to be really tough or difficult or going to require like a tremendous amount of innovation that could fail. I've never really been worried about that because I've always looked at it and said to myself, yeah, I'm really going to grow with that. Like the outcome is going to be the outcome. And damn it, I'm going to force it through to success. I don't care. In any case, I'm going to be a much better person for it. And so I haven't thought of it so much in terms of the role that I'm even in. I've thought it more as, and maybe that goes back to a little bit what we're talking about here, right? I'm in a CFO role, but I can speak the language of the other departments, right? I can sit down with our CTO, or I can sit down with a number of different groups and understand pretty intimately what they're dealing with. And I think that's a product of the fact that I've always been comfortable putting myself in those situations. And so for me, regardless of what my title is or where I am, I feel well positioned to tackle business challenges, right? And obviously I've built my acumen in finance and that's been my primary mandate. But I guess my advice would be that when we talk about technology, and to me, technology is like innovation, because again, like technology in 10 years is going to look very different than it looks today. And I think to be innovative, whether it's like the way you manage people, you build the business, you build your technology, to do those things, the best thing you can do is expand your mind as broadly as you can to different sides and different ideas and different ways of working. And the more you do that, I think the more innovative you can be. And so as people will joke with me about, I'm the CFO and I'm the guy who's going to tell you no to not doing this or that. But the reality of the situation is like, the way I think is, let's take an idea, let's really attack it, break it apart inside out, and then find what's good in it, and then go at it with full force. So to me, it's not really saying no, it's saying let's find the best thing about what this is and go after it full force. So I view that as like pro growth. And I think executives of the future will probably benefit from that because as much as I'm saying the world is moving fast now, I'm sure executives 50 years from now would laugh at that statement in the year 2024.
They had to type their own emails. What the heck? Who
Right.
does that? What's
Right.
an email? Remember those
Yeah.
things? Yeah.
Yeah, it'll be embarrassing when I have to talk to my grandkids, I know.
Excellent.
Okay.
Jay, I'm out of questions. I've thoroughly enjoyed this. Anything else you want to throw Bill's way?
One more question I have is typically on this whole buzz around AI, right? Or how things are going. And it's again impacting every department, impacting every one of us. And we have repeatedly heard that it's not going to replace our job, but people using AI is going to replace my job. So the question really is that as a CFO, it's a very emerging technology. You don't know what will work, what will not work. For example, I was in a IDC conference on Gen AI, and companies are investing millions of dollars to do something because these are expensive models to train and you require a lot of infrastructure also to do it. So my question to you is, how do you look towards AI? What's your perspective towards AI, and which areas you feel you will be comfortable investing if your company comes back with a business case to you saying that I need $5 million bill to do something? How would you evaluate that?
Yeah, I think I'd evaluate it sort of the way I just said, which is pick it apart and break it down to what works in that idea. And what I mean by that is take AI as this big global topic, right? I think one of you made the comment earlier, something about investing in tech in the past and investing in tech now, and what's the difference? And it was like, it was tech. And I think the reality is if you go back 5 years ago, 10 years ago, there was an element of somebody in tech would say, we're investing in something that's quote unquote tech, and it would happen. But there wasn't the degree of discernment around what exactly is that tech doing. It was just like, it was tech, right? And that's the difference today with tech is what's like a distribution of expectations from that? What needle is that going to move for us as a business that makes it worth our while to do that? And so I think with AI, you can't be too open. You need to evaluate everything, but you have to figure out what like the phasing and pockets of AI are that will make sense as it rolls out. Obviously, generative AI is as one, as you just mentioned, like there are use cases right now in our business that we're deploying that for because they make perfect sense. But you still have to dig in deep and understand the questions like, what happens if there are hallucinations in that model? And like, are we actually, in some businesses, like there's liability to that, right? In others, it's okay, I'm just giving my employee better information and they understand that they need to be a check on that. And so it very much depends on your business. If your business is loaded up with information and data from years past, consider possibly using that. But then you have to think about what am I actually going to get out of it? Am I augmenting my existing product? Am I making people more efficient? Am I making people more informed? And what's the return on that? I think there's no doubt across the spectrum, there's going to be excitement about deploying anything AI. Everybody wants to get it in their investment deck as they go out and say, we're an AI company and so forth and so on. And as we know, that's often a little bit of an embellishment at this point, but picking off the pieces that actually have tangible use cases today, and then going forward to my prior, which is what's the world going to look like in 5 years? You can't settle on that. You have to say, what does phase 2 look like? What are our use cases going to look like 4 years down the line? And how do we get ahead of people in a meaningful way and pick our bets on those sorts of investments? So long story short, what's great about AI today is that there are tangible ways to use it in productive ways. And what's exciting about it is I think that many of those tangible things aren't tangible now, but they'll be tangible down the road. And everybody has different opinions on that. I've heard there's a subsection that's good today, but it's going to take 20 years for the rest to open up. Some think like little pieces will open up over time. Everybody has a different opinion. We'll have to see how it unfolds. But if you stay on top of that, ask the right questions and hone in on what the outcomes are going to be, that's how I would approach it as CFO.
Okay. So you are going to look at the outcomes, look at what ROI it is, break it down, and then decide to make an investment, right?
You could put it in 2 buckets, which is what is this going to do for me now? And how is this going to be a differentiator in the future?
Okay. Oh, good. Oh, that's a nice way of looking at it. Okay. Oh.
But Bill, you sure you can't just use ChatGPT to find 27 different ways to say no to all the other proposals you get to spend money?
Actually, that's a great idea. That's a great idea. Unless there is a hallucination and ChatGPT opens up 100 million in budget. ChatGPT is a useful thought generator too. I use that for stuff. It's a viable, helpful product today, but it's what you use it for is what matters.
Correct. And my daughter was home this weekend and she was saying the same thing, that I can't imagine my life without ChatGPT now.
Yeah.
And how long it is, 3 months she's been using. She said it's helpful in every area. It gives me or opens up my perspective. Also, it's not just giving me precise answer, but I think it's opening up my perspective of I should learn this, or I should dig into this, or I need to know more of this. So the way my generation, older generation thinks about it is it's trying to give you a specific answer. And that's why it's bad you're not doing the research.
Yeah.
But what I learned from her was, no, it's not giving you a specific answer. It's giving you its perspective, but opening up the perspective of saying that you should know about these 5 things if you really want to master this topic.
It's sometimes for me, what it does is even just communication stuff. I'll think about tackling an idea. Maybe I'll be like, yeah, I would say that's 4 things impact that 1 through 4. And you'll ask ChatGPT the question and it'll think about it in a totally different way that frames it in a way that's not anything like that. And you go, oh, actually that resonates a little better, I think. So you'll get different little ideas that give you new perspectives that aren't necessarily in the front of your mind. And I think it's really helpful. It's a cool thing.
Okay. It's very nice talking to you, Bill. I enjoyed the conversation.
Yeah,
Again, I don't have anything, but before we close the podcast, any last thoughts from your side?
No, I just wanted to say thank you for having me. Always love to talk technology, and it'll be fun to come back. Have me on in 10 years and we'll see what's going on with technology at that point.
I think we don't have to wait 10 years. Maybe next 5 years, we will be talking to your persona, right? Rather than talking to you real, and you can get 3 places, 5 places at the same time.
Our personas talking to your personas. We'll just have someone else do it for us.
You never know.
Okay, man.
No scheduling conflicts. That'll be great. No one will ever have a problem with calendar. Yeah.
No, thank you so much. It was a pleasure to be on this, and appreciate you having me.
Thank you. Thank you. It's very nice talking to you.